How can I make sure my kids actually receive this money without the government taking a huge bite out of it? I'll show you exactly how to pass on your wealth. Disclaimer: this video is for educational purposes only. It is not financial advice. Please speak to a licensed professional before making any financial decisions. Chapter 1. Keep it updated. Your plan is only as good as the last time you updated it. If your will or trust is more than 5 years old, it's probably outdated. Did any of these happen recently? Did one of your children got married or divorced? Have you gained new grandchildren? Do you have a beneficiary who passed away? Did you move to a different state? Or maybe the tax laws have changed. All of these can make your current plan invalid, unclear, or even harmful. So here's your action step. Do an estate checkup every 3 to 5 years. Review your accounts. Check your beneficiary forms on IRAs, 401ks, and life insurance. And remember, beneficiary forms override your will. So if you forgot to change it after a divorce or death, the money could go to the wrong person. A small update now can save your family huge problems later. Chapter 2. The hidden danger of retirement accounts. If you leave a traditional IRA or 401k to your kids, they'll owe income tax on every dollar they take out. So if you pass on a $300,000 IRA, they don't get $300,000. They get what's left after taxes, often just $200,000 or less, depending on their tax bracket. And it gets worse. Thanks to the Secure Act, most non-spouse heirs now have to withdraw all the money within 10 years. That can push them into higher tax brackets fast. So what can you do? Here are 3 smart moves. 1. Roth conversions. You pay the taxes now, at today's rates, and convert your IRA to a Roth. Your heirs can then withdraw it tax-free later. 2. Charitable remainder trusts, CRTs. These can provide income to your heirs and donate the rest to charity while reducing taxes. 3. Use IRAs for giving. Leave your IRA to a charity and give other, more tax-friendly assets to your kids. It's all about strategic asset placement. Put tax-heavy accounts where they'll hurt you the least. Chapter 3. What happens if your kids divorce? You want to leave money to your kids and maybe not to their ex-spouses. But here's the problem. Once your child inherits money or property and mixes it with marital assets, it can become fair game in a divorce. You can prevent this by using a trust instead of a direct inheritance. By leaving assets in a trust, you control when and how they're used and keep them separate from your child's marriage. Or you can add inheritance protections in your trust documents. Include specific clauses that keep distributions separate from shared accounts or property. And maybe you can talk to your kids about prenups. It might feel awkward, but it's wise, especially if there's a large inheritance involved. You're not being cynical, you're being realistic. More than 40% of marriages end in divorce. Make sure your legacy survives the fallout. Chapter 4. Trusts, LLCs, and powers of attorney. Want to pass on your wealth the smart way? Let's start with the most powerful tool, the living trust. A living trust avoids probate. This means taking the right steps to ensure that your assets will be directly passed to your beneficiaries without going through the formal probate process. It gives you control while you're alive, makes transfers simple and private, and it can reduce or eliminate estate tax in some cases. It's not just for the wealthy. Anyone with a home, savings, or life insurance should consider one. Another option is a family LLC, or family limited partnership. You place assets, like rental property or investments, into the LLC. You control the company but slowly transfer ownership to your kids over time. The benefits are that you stay in charge, you lower your taxable estate, and you can add protection from lawsuits or creditors. Because if something happens to you like a stroke or dementia, or an injury, you want your kids to act quickly and legally without court battles. Think of these as tools to protect your family from taxes and confusion. If you find this helpful, please give the video a thumbs up, subscribe for more clear advice like this, and tap the bell icon so you're always the first to know when a new video's out. Chapter 5. Give now, not later. The power of gifting. There's one simple way to protect your kids from inheritance tax. That is by starting giving now. You're allowed to gift money tax-free every single year. In the US, as of 2024, you can gift up to $18,000 per person per year, with no tax owed by you or the recipient. So for example, if you have 2 children and you give each of them $18,000 per year, that's $36,000 out of your estate every year. Over 10 years, that's $360,000 moved tax-free, and that's just from you. If you're married, your spouse can do the same. In other countries, gift allowances may be different, but the principle is the same. This strategy doesn't just reduce future tax, it also lets you see your kids enjoy it while you're still alive. A tip: always transfer gifts through the bank. Keep clear records, and consult with a tax advisor before making large gifts or using one-time exemptions, like for home purchases or education. Chapter 6. Leaving a legacy through education. Not every inheritance has to be about stocks, houses, or bank accounts. One of the smartest things you can pass on is education. Did you know you can pay for your grandchildren's tuition directly to the school? And it won't count as a taxable gift? That's right, no gift tax, no paperwork hassle, no limit, as long as it goes straight to the institution. You can also set up 529 college savings plans, which grow tax-free if used for education, fund trade school or certification programs. Not just four-year degrees or use custodial Roth IRAs for older teens who work part-time. That's a way to teach them investing early and help them grow wealth tax-free. Your money doesn't just have to pay bills, it can plant seeds that grow for generations. And it's a way to leave more than money. Chapter 7. Life insurance, the tax-free transfer tool you might overlook. Life insurance can be one of the most tax-efficient ways to pass on wealth. Why? Because in most cases, life insurance payouts are completely income tax-free. Let's say you take out a $250,000 life insurance policy. You pay a monthly premium, and when you pass away, your kids get the full amount without probate and without income tax. Now it gets even better. If you place the policy inside an irrevocable life insurance trust, or ILIT, it's also excluded from your taxable estate. That means it won't count toward estate taxes either. This strategy is especially powerful for seniors with large estates, parents who want to equalize inheritances, and families with real estate or business assets that aren't easy to split. Tip: work with a financial planner to make sure the policy is structured correctly. Premiums, ownership, and beneficiaries all matter. In short, life insurance isn't just for young parents. It's a stealthy tax-saving tool for smart seniors. Chapter 8. Planning for long-term care. Long-term care can wipe out your savings faster than any tax bill. Nursing homes and assisted living facilities cost $5,000 to $10,000 a month in many areas. You may be forced to sell assets or drain your estate just to afford care, leaving nothing behind for your kids. So what can you do? Option 1. Long-term care insurance. This helps cover future care costs without eating into your savings. Option 2. Asset protection trusts. In some states, you can move certain assets into a trust years ahead of time, which might help protect them from Medicaid spend-down rules. Option 3. Long-term care policies. These give you benefits for care now or a death benefit later. Planning for care isn't about being pessimistic. It's about protecting your legacy. Chapter 9. Your home can be a trap. For many older adults, the house is their biggest asset. But here's the problem. When your house passes to your children, it often triggers a large tax bill, especially if the property has increased in value. And if your kids want to keep the home rather than sell it, they may be forced to take out a loan just to pay the taxes. So how do you avoid this? One option is a life estate deed or transfer on death deed. This lets your kids inherit the home without it going through probate, and possibly with a step up in tax basis, which means they won't owe capital gains on past appreciation. Another option is sell the home while you're still alive, downsize or rent a place to live, and use the leftover money to fund tax-free gifts, investments, or trusts. You can also use a qualified personal residence trust, QPRT, where you transfer the home to a trust but retain the right to live in it for a number of years. And don't forget, if you're married and own the home together, you'll want to ensure your will or trust handles it properly, so your heirs aren't double taxed when the second spouse passes. Your home shouldn't become a financial burden for your kids. With the right plan, it can become a blessing instead. If you find this helpful, please give the video a thumbs up, subscribe for more clear advice like this, and tap the bell icon so you're always the first to know when a new video's out. Chapter 10. The power of a step-up in basis. A tax rule that's called the step-up in basis. Here's how it works. Suppose you bought a stock for $10,000, and by the time you pass away, it's worth $50,000. Normally, if your kids sold that stock, they'd pay capital gains tax on $40,000, but with the step-up rule, their cost basis becomes $50,000, the value when you died. So if they sell it right away, there will be no capital gains tax at all. This rule applies to stocks, real estate, mutual funds, and some business assets. But be careful. It doesn't apply to retirement accounts like an IRA and 401k and gifts made while you're alive. So if you give your house or stocks to your kids before you die, they don't get the step-up. That could cost them thousands. Bottom line, in some cases, it's better to pass assets after passing away, not before. Chapter 11. Naming the right beneficiaries. This one sounds simple. If you have an IRA, 401k, or life insurance, the person listed as your beneficiary gets the money. It doesn't matter what your will says. That one form overrides everything. So what can go wrong? For example, you never updated it after a divorce, or you left it blank, so the money goes through probate. Or you listed a minor child without setting up a trust or guardian. Or even worse, you only named one child and forgot the others. Here's the fix. Review your beneficiary forms every 3 to 5 years. Make sure they match your current wishes, and consider naming contingent beneficiaries in case something happens to your first choice. A simple update here can save your family from a major headache later. Chapter 12. Digital assets. We live in a digital world now. Bank accounts, bills, emails, even cryptocurrencies. But if no one knows your password or that your Bitcoin even exists, that money could be lost forever. You can make a list of your key digital accounts: email, banking, investments, insurance. Then store your passwords safely in a secure password manager or locked folder. Also wise to do is creating a digital will, giving a trusted person access and permission to manage your digital life, and name a digital executor in your estate plan. It might feel odd to plan for your online accounts, but for your family, it can mean the difference between clarity and total confusion. Chapter 13. Blended families. If you've remarried or have stepchildren, listen carefully. By default, the law often leaves everything to your current spouse, which means your biological children might get nothing, and that can cause deep pain, even lawsuits. You can avoid this by using a QTIP trust. It can provide income to your spouse and then pass the remaining assets to your children. Be specific in your will or trust. Spell out exactly who gets what, and talk with your family. It may feel uncomfortable now, but it prevents confusion and resentment later. Blended families deserve clarity, and you have the power to give it to them. Chapter 14. Special needs planning. If you have a child or grandchild with special needs, this chapter is critical, because a direct inheritance can accidentally disqualify them from government benefits like Medicaid or SSI. The solution is using a special needs trust. It allows you to leave money for their care without affecting their eligibility. Choose a trustee who understands their needs and work with an attorney who specializes in special needs planning. It's not just about money. It's about protecting their dignity and independence, even when you're no longer there. Listen, most people avoid this topic because it feels uncomfortable, but planning your estate isn't selfish. It's an act of love. You're not doing it for you. You're doing it so your family won't suffer, argue, or lose what you worked so hard to build. If this video helped you, give it a thumbs up. It really supports the channel. And if you haven't already, subscribe for more clear and honest guidance. It really means the world to me. Don't forget to click the bell so you'll be notified the moment a new video is released, because the right information at the right time can make all the difference. Thanks for watching, and remember, smart planning today can mean peace of mind for your family tomorrow.